Balance is the name of the game right now for stocks. So Stephanie, with markets still trading on Europe and headlines really coming fast and furious, what's your weighting of, say, safety dividend plays and the riskier cyclicals?
Well, we are overweight on the cyclicals because we do think that between now and the end of the year, you are going to see this chase. And I think that those are the stocks that are the cheapest, particularly because I don't think the economy is as bad as people expect, or at least as bad as the stocks are reflecting. But I do think it is a very important part of your portfolio. You can't just be all in one stock or all in one sector. You've got to have a balance. And so we do have some healthcare, some staples, but I kind of feel like we own some growthy defensives, if you will.
So what would be the growthy defensive then? Give me a few names you do own.
So Sanofi is one of them. Unilever is another. I think those two stories, they trade very much because they're located over in Europe. They trade with a lot of volatility. So you have to kind of use that volatility to your advantage. And both companies reported really strong quarters, actually, just last week. And the stock sold off, and I really think that those are great stories for the long term.
So despite the fact that they operate in Europe, how much of their revenue is actually from Europe? I think it's an important distinction for people to realize.
About 20%.
Okay.
I mean, you're really owning both of those companies for their emerging growth exposure. You had the BRIC countries for Sanofi grew 20% in the quarter, and Unilever, actually, they're up to about 52% of their total sales as emerging markets. So I like the emerging markets story for both companies. The management teams are fabulous. And they're kind of like turnaround stories because they do have fairly new managements with fairly new products, each of them actually.
Do you think the risks for Europe exposure are priced in at this point for those two stocks, or maybe even overdone?
Oh yeah, I mean Unilever is trading at a 14% discount to its peers. Sanofi a 25% discount to Glaxo alone, and I just don't think both of these companies, they're not going anywhere. They're very stable stories. They've got great free cash flow, dividends, very attractive. And again, it's the product cycle story that I like, that I think is going to lead to above average growth for the next couple of years.
Now, in terms of Sanofi, though, don't they have about 4 of its big drugs losing patent protection by the end of this year? And what will that do for them longer term?
Yeah, so 2012, it's very well known that that's going to be the trough year. I mean, we write about it all the time. It's the trough year, and everybody looks at it that way. We all know it. We all know that all of the major drug companies have huge patent problems. The issue here is, which companies have really identified these problems, and who has the best growth beyond the trough year, right? So Sanofi, the reason we chose it, not only for the BRIC countries and because of exposure and because of the product cycle story, they bought Genzyme. And we think the integration of Genzyme gives them a huge leg up in growth and in cost synergies, and will lead to 5% earnings growth and over 9% sales growth after the trough year.
And then, so in terms of levels, Unilever and Sanofi, where would you be buying?
I think the low 30s for Unilever. I mean, that's when the dividend yield gets attractive, and actually the same for Sanofi. We've been buying Sanofi this week.
All right, thanks, Stephanie. I really appreciate it. All right, so you want to get some exposure to the cyclicals, the riskier stocks, but there are 2 safety plays you do not want to miss out on.